reason they're tripling is because, quite precisely, people are waking up to this idea that you have that's so important, that you have no non-correlation, you have no true diversification, and you have no tail in any way. You have no brakes. Everybody's driving without brakes, and nobody really cares about that if they're on the racetrack and if the racetrack hasn't been wet for a while, or right, like it's very predictable. There's not a lot of, well, guess what? 22 showed that there's a little bit of water on the tracks, and we're going to take this metaphor all kinds of places.
I say all the time, one of another dredgeism, history alone is a very poor measure of risk.
Absolutely.
Because it only tells you what did happen, not what could have happened. So the simple analogy I use all the time, 2 guys climbing up a cliff face. One has a rope, one doesn't. Financial market backtesting would say if they climbed at the same pace, they had the same risk.
Right.
Well, obviously one has a lot less risk if it's raining the next time they climb. And logically, the one with the rope could climb faster.
Right.
And that's the whole point. Again, get the protection and then take advantage of it and go out and find that convexity to the upside. Go out and pursue cut off the unrecoverable to pursue the unimaginable.
Well, and not just that. I mean, I think we both know, actually a big, core thesis of how you trade is often the least, what seems historically the least likely is reflexively often the most likely. People are rarely fighting. Everybody's fighting the last war, right? And it's generally not hedged for the war that hasn't happened.
Well, the reason things are correlated in the downturn is because of leverage, because the financial system allows leverage to accumulate based upon assumptions of low volatility as low risk.
Right.